everybody. This is Denise Barrett, host of The Real Deal. I am a realtor and land broker in North Texas. Thanks so much for landing on our channel today. Here at The Real Deal, we talk about all kinds of topics regarding buying and selling real estate in terms of residential real estate or land. Today, we're talking about money. This is not my strong suit. I am not a tax professional. I am not a CPA. I don't give any kind of financial advice. In fact, given my preferences, I prefer to count on my fingers when nobody's watching. But it is important for you to know about if you are selling properties. This is something called the 1031 exchange. This is something that was added to the United States Tax Code in 1921. And the purpose of it is to defer the taxes on capital gains on the sale of a property by purchasing another property of the same or equal value. That was a very long sentence, but let me see if I can't break it down for you. Now, this does not apply to every time you sell a house, right? You want to sell it for a profit. We don't ever want you to not make money on the sale of your house. It was supposed to be a financial tool. But if the gain of that property is going to exceed $250,000 if you're a single person, or $500,000 if you're a married person, and you have lived on that property for the last 2 of 5 years, then you need to know that proceeds in excess of that amount can be assessed a capital gains tax. Now, how do you avoid having to pay that tax? Well, you do it by purchasing another property of equal or higher value. This allows that capital gain to basically be held by a qualified intermediary or an escrow agent. This is like an escrow agent on steroids. They deal with a lot of high dollar amounts here. They hold those funds until the property is sold again. Now, there is a specific timeline for making this transaction work. There may be some nuances and some additional timelines over and above what I'm going to talk to you about. You'll want to talk to your CPA about your specific situation to see what is going to apply to you. But these are general parameters, okay? So, the owner of a property decides to sell it. It goes under contract. It does close successfully. The proceeds from that sale are held by a qualified intermediary or an escrow agent, while the seller then identifies another property to purchase. The seller has 45 days to identify the property. If you're selling real estate, you have to buy real estate. They have to be like kind and quality of property. So you have 45 days to identify that property. You have 180 days to close that property. And then those funds are assessed or assigned to that new property. So you didn't have to pay capital gains on this sale. Why? Because the gain was placed into another property. Now this is repeatable. You can do this over and over again, and you're not assessed the capital gains until the sale of the last property. Now, this is something that you're going to want to touch base with your accountant on. This is a wonderful tax tool. You want to make sure that you use it correctly. The title company that you use to sell your property is going to have a resource for you. They're going to have a 1031 exchange company that they do business with. Those are great people to know and have your best interest in heart. So there's that money topic. If you have any questions about it or concerns, you can address them to me. If we get into the weeds on money matters, I'm going to refer it to a CPA. But thanks so much for stopping by today. It's always a great time to see you and talk to you about something that has to do with the buying and selling of real estate. If you think you're going to run across some topics that could be addressed, just drop me a note. I'm happy to take a look at those. Like and subscribe. And in the meantime, I'll talk to you next Tuesday. Bye-bye.